All right, it looks like most people have signed in. Let's go ahead and kick off our second webinar. Welcome, everybody. I appreciate you joining us. My name is Lucas LaChance. I am the partner for practice growth at LGT. This is the second in our 8-part series of webinars focused on running your business better. Today, we'll be focusing on how the business banking relationship sets you apart. I see a lot of familiar faces signing in, which is great. We always appreciate that continued support. But I also see some new folks that are joining us. And so let me give you a quick overview of LGT and what we do here. Our firm is a public accounting firm. We handle everything that you'd expect, which includes our department's accounting and consulting services, which is bookkeeping services, maybe month-end close, business advisory services, CFO by the hour, and maybe things like buy and sell side due diligence. We also do all kinds of assurance work, including compilations, reviews, and audits, a very robust tax group covering state and local tax issues, of course, anything federal, and even international tax filings. And lastly, our financial advisory group, which helps individuals with their long-term financial planning. Our areas of focus are construction and commercial real estate, not-for-profit, auto dealers, and manufacturing and distribution. So let's do a little bit of housekeeping before we get started. This webinar will offer you 1 hour of continuing professional education. You will need to fill out the evaluation at the end of the webinar in order to get your certificate. This is not our first rodeo, we're holding it hostage. And one of the things in the evaluation is that we would like for you to give us topics for future webinars. We do these with our business owners and our clients in mind. So we want to make sure that what we're doing is tailored specifically for you. The webinar should be available on our YouTube channel in approximately 2 days. And if you have any questions during the event, please use the Q&A function. We will gather those up and follow up with you individually after the webinar. Often the questions are very specific in nature, and so we want to make sure that we're giving you a very specific and tailored answer as well. So with housekeeping out of the way, that brings me to my 2 special guests. Please welcome Jason Matthews with Dallas Capital Bank. He is the Chief Banking Officer. He oversees the commercial banking, private banking, commercial real estate, treasury management, and mortgage warehouse. He has more than 2 decades of banking management. He's also a Baylor Bear.
Sick 'em.
That's right, a Baylor Bear, where you received your bachelor's in business administration. And you are also serving the community, currently on the board of Goodwill Industries. We're joined also by Darren Durrett. Darren leads our commercial bank. He also has 2 decades of banking experience. Formerly, he was the market president for Truist Bank. Another Baylor Bear who also received his BBA. He's currently on the executive committee for the Richardson Chamber of Commerce and is the immediate past chair of the Garland ISD Education Foundation. I'm sensing a pattern with the 2 decades of experience and the Baylor Bear. Guys, thanks for joining us. I appreciate it.
Yeah, thanks for having us. Yeah, Lucas, thank you so much for having us. We're happy to be here.
Great. So maybe tell us a little bit about Dallas Capital Bank before we get started.
Sure, I'd love to. Dallas Capital Bank is a locally owned, locally managed, Dallas-based bank. We actually formed an investor group, partnered with a management team, and we put this bank together, just had our 8-year anniversary, actually, May of 2015. Raised capital, as I said, from our investor group, about 35 shareholders, all local family office type folks, purchased what was a community bank that had been in Dallas for a long time. Town North Bank was the name of that bank. Purchased that bank again in May of 2015, rebranded, renamed to Dallas Capital Bank, and have been doing what we're doing here ever since. We're about $1.2 billion asset size. And really serve a variety of different areas of different specialties. Darren, you want to speak to that?
Yeah, so we kind of talk about the 3-legged stool, which is sort of our business. We've got 3 lines of businesses and then kind of one that sits on top. So, we have, of course, kind of unique to most banks our size in this area is a C&I bank, which C&I stands for commercial industrial. Just think of it as another word for commercial banking. So that's your, owner managed companies, kind of multi-generational, privately held, between revenue size of 10 million to 200 million. But it's all the things that go into, the day-to-day banking operations as far as treasury services and deposits and the platform to do that. Lines of credits for working capital, CapEx needs, owner-occupied real estate, just sort of your blocking and tackling commercial banking. That's our C&I group. That's the group that I run. But we also have what we call our CRE group, which is we do all things, in commercial real estate. So, retail, industrial, hospitality, all that kind of stuff. And that's run by a gentleman named Patrick Brown in our group. And so that's our kind of third line of business, or second line of business. Our third, it would be our private bank, which is really just a traditional private bank. It's loans and deposits to a lot of our business owners and individuals bank with us personally. We do bank a lot of high net worth individuals, do, lending to, single family, semi-residential mortgages, airplanes, ranches, second homes, vacation homes, things like that. Just kind of what around the private bank. That's really all we do. No money management or anything else like that. And so those are kind of the three lines of business. And then one of the really important ones that sits right on top of that, which is kind of the cap to our stool, is our treasury management department, which is all things how money moves in and out of the accounts and the platforms and that kind of stuff. And that's led by Wendy Blackwell in our group. And so those are really, that's kind of how we're structured. And I mentioned it's a little bit unique. Like I mentioned, a lot of banks our size don't have that C&I focus. Is really in our DNA. A lot of us come from sort of larger banks, and we found the idea was there's a niche in this market, sort of that lower middle market space in those companies, to have a local decision making, quick response, and then obsessive service. And so that's just kind of how we're set up.
Yeah.
That's one of the things that I love about the partnership between our firm and Dallas Capital, is that you basically could have been describing our client base. Privately held, often multi-generational. I love also locally owned. We've been around. It'll be 75 years for us in 2025. So thanks. Long history in Dallas, but that's what makes, I think, the partnership so valuable between our two companies. So, all right, well, let's dive into the meat of this. Okay, so there are a lot of banks in the DFW market. What should business owners and operators look for when selecting the right banking partner?
It's a good question, Lucas. That's timely. We just actually published our 2022 annual report, and we titled it Relationships Matter. Our 2021 annual report was titled Where You Bank Matters. and we believe we would be biased, of course, but we believe it really does. For a business owner in this lower middle market segment, as we've described, or even your CRE projects, investor developers, having a relationship with a bank is the biggest differentiator. I read an article recently that there's 4,300 banks in the country, so we're about to, and even in the DFW market, we're at 175.
Wow. Okay.
Individual banks with a presence in DFW. The vast majority of those would not be locally owned or locally managed. A lot of times there's great bankers at those banks. We know a lot of those folks, but even in some of those cases, the headquarters, the mothership, if you will, is still out of market. It's either somewhere else in Texas, or most oftentimes it's out of state. And so we believe that when you think about a bank that you want to partner with, because that's really what you're doing, you're bringing on a financial bank partner, not an equity partner, but a financial bank partner, senior debt bank partner, having somebody that you've got access to, that is responsive, that gives quick decisions, that is a decision maker themselves in the overall organization. Is not we talk a lot about order taker bankers. Make sure you're not talking to an order taker banker, but somebody that's empowered with that organization to help make decisions on your behalf. And then I would also state, having a bank that you feel good about their technology from a deposit treasury perspective. So much of the deposit business is done online these days, wire, ACH, online banking. Very few people go into a bank anymore, either personally or commercially. And so having a bank that takes their technology seriously and is really invested heavily, I think is going to pay dividends for the business and the business owner.
Yeah, I think it's tough. It's tough to cut through the noise and figure out. What there's like Jason mentioned, 175 banks in town, and really what it comes down to is it's that relationship. A lot of times it's just that relationship that a business owner or operator has with their banker, and then this level of trust. Over the years, as you mentioned, Jason, I've been doing this for a long time. We've kind of noticed the talent pool in the banking industry, and as there's more banks come, there's less bankers, and people are coming in that sort of thing. But if you think about it, it's really the banking business can be generally, it's just a commodity. Everybody takes loans and deposits, and you could kind of boil it down to that. But if you're a business owner and you've had an issue, or when you really needed your bank, you probably know that there's much more than just the actual action of just transacting with a bank. The relationship, like Jason mentioned, the ability to have decisions made quickly, to really respond, is kind of where is sort of why we exist in that. But it's really interesting because if I was a business owner and I was looking at a bank relationship, I want to know what's the value add. Yeah, you can take my loans, deposits. I'm going to get the best rate because I'm the best client you got.
Yeah,
obviously.
And all 175 of those banks make loans and they collect deposits. Right. It's a commodity.
But it comes down to the value add is the advice, the experience, the availability, and that sort of thing. And so as we're working with our clients and everything, we're not, there are times when we've been asked for, I need a loan for this. And we may come back and go, hey, that's really not the best thing for you. Yeah. And here's why. And really what that means is we've got, your banker needs to be very experienced to understand, first of all, what your business does, how it works, not only how it works and what it does, but what you as a business owner want to do with that business in the short term, the long term, like where you want to go. And then together you make decisions and provide advice that would further that along that progression. And not just, hey, I need a loan. Okay, well, I'll get back to you in 2 days. It's more of, let me really understand your business, what you're trying to do. And I may come back to you and go, I know that you're wanting to go here. If you do this, this is what, this might set you up or set you back in that. Have you thought about this? Or, that kind of thing. And the other thing that is really important is who your banker, and a lot of our bankers just really connected to the community. A lot of us are just connectors. And so, if you're a business owner, you kind of think of, who's my advisory, my staff. You've got your attorney, you've got your CPA, you've got your banker, and that's kind of, who would advise you on how you run your business every day. A lot of times people don't think about the bank as being an integral part of that. It's just a necessary evil because some people just don't like banks or have had a bad experience in the past. And so, as you're choosing a bank partner, you really need to understand who it is you're dealing with and what they bring to the table. And that value add, as far as, service is a big piece of that. I think that's one thing we obsess about with the kind of we have this boutique white glove type approach to service. Service is a big deal, but just the advice, experience, and expertise, and then the availability of leadership. There's been a lot of times in recent history where we've had clients, ask us questions, and we have direct access to our leadership, whether it's Jason, our CEO, Doug Hutt, and just sort of the availability just to get together and really, show the value of what we bring to the table as far as the partner, because it really is a partnership.
Yeah. Who you bank with does matter. We would argue it actually matters more in times of stress, economic stress, or challenging times than it even does during times of prosperity. During prosperity, you overlook faults more easily. Everything's working well. You're making money. It's in the challenging times that who you bank with actually matters the most. Look no further back than COVID and PPP. And when all these business owners needed PPP loans, and the government tasked the banks with the ones to facilitate the administration and the funding of those PPP loans, it was by and large the community banks, the regional banks that stepped up and funded those PPP loans. And those were times of stress and dire need. So we think there's an important component from that perspective.
You teed it up. That's exactly where I was headed, about circling back to the idea that the relationship is the central piece of it, particularly in times of crisis. And the different federal programs that were available recently, and banks really were on the leading edge on how people were able to keep their businesses afloat.
Some better than others. Right?
That's true. Okay, so we talked about lending. That, of course, leads us to our natural progression into interest rates. So interest rates have been on the rise. There's a lot of talk of inflation. What does this mean for business owners?
Well, yes, interest rates have been on the rise pretty rapidly. And, we actually just took our bankers on an offsite and had a really nice conversation with them as we were all just getting our heads around what's happened over the last 14 months.
Right.
And so if you step back and kind of recap that, rates have increased 5% in 14 months. Right. Fed funds has gone from 1/4 to 5 1/4, and prime has gone from 3 1/4 to 8 1/4. There's some borrowers out there paying prime, Wall Street Journal prime plus something. That could get you into the 9% kind of range, where historically you were in the 3% kind of range. That's a massive difference in a very short period of time. Again, the reason that Fed is tried to raise interest rates that quickly and that significantly is to try to tame inflation, which also goes back to the COVID period of time when they decreased rates to effectively zero, Fed funds to effectively zero, and combined it with significant stimulus dollars that put a ton of liquidity into the market. And then over the course of the next 2 years, we saw what happens when those two things happen, which is inflation. And this is obviously in an effort to combat that. So, gosh, how does that affect business owners? Well, one way it affects business owners is your loans cost more, right? The interest expense that you're paying on whether it's a floating or whether it's a fixed rate, even if you're trying to go get a fixed rate today, a fixed rate is also going to be up significantly from where it was just 14 months ago. So your borrowing costs are up. Alternatively, something else that should be up is the rate of interest that banks will pay you on your deposits. That's also up. I mean, it was only 14 months ago that a high yielding money market would be, 25 bips or 40 bips or 50 bips, very minuscule. And now you're seeing money market rates in the 4% range and up. You're seeing, we see billboards talking about CDs in the 5% range. Wow. So you can now actually earn something on your excess liquidity. Right. I don't know, Darren, what are you seeing there?
Yeah, it's interesting because for the longest time when you're not getting paid anything, you
on your deposits,
you can just, not pay attention to it. And I think the market is pretty much woken up and said, oh, hey, wait a minute.
Yeah.
So it leads to a lot of conversations as far as, hey, what can I get? And then obviously there's a lot of, everybody's trying to play their different angles in that. And, it's really important, I think, if you are a business owner or anybody, maybe I'm just a banking nerd, but just to really understand what's going on. And what is that, why is that? And then what's out there and why would a bank do certain things and not do certain things as far as how they price things? And, because you can borrow overnight, banks can borrow overnight at the Fed at 540 right now. So, anything they pay on a deposit would be the arbitrage between that. And so, if your bank's paying very high, you might ask questions and say, hey, why is that? But I think in general, we have a pretty healthy banking economy here in town. And I think that ends up being a really good thing for the clients, because they can pretty much drive and get what they need as far as those kind of returns. But that's, we've seen a lot of folks, kind of move their money into those yielding accounts. And we haven't had any issues there as far as, that goes, but it's just led to a lot more conversations. As I would say, what I'm seeing is a lot of our conversations are more on the depository side than the loan side right now. We like to say we're still open for business. We want to lend as much money as we can, but I think people just, it's a hard pill to swallow when if you're going to, want to finance something to lock in the rate long term at, an 8 or 9% or whatever it is at this time.
No question. I think historically when rates were low, the thought was, let's go more fixed rate from the business owner's perspective. What if we're going to do something fixed rate? And some types of loans are more easily structured fixed than floating anyway. But certainly borrowers wanted to fix more back then. There's a thought to be had now that maybe we've peaked on interest rates, maybe we haven't. Maybe we start coming back down here at some point. That funds futures would have us have a couple of cuts before year end. Who knows if that comes to fruition? We certainly don't. But if that does take place, then maybe a floating rate structure is something you want to think about, because you want to be able to float back down when rates come back down, as opposed to locking in on something fixed. Most of those fixed rate loans today are going to have prepayment penalties in them, whereas floating rate loans typically do not. So there's give and take to both, but it's much more of a conversation today than, of course, it was 12, 14 months ago.
I think one of the interesting things that we've seen recently is are CDs.
On the deposit side.
To me, I don't know when the last time I opened a CD for a client was. I think I did one for my grandma. But historically, CD rates have not been that attractive, and for a while there, a lot of people were looking at T-bills and things like
treasuries,
treasuries to go into, and there was a pretty big discrepancy as far as what they paid versus what banks would pay on their CD. And as people, the flight to that has brought those down. And so, maybe a tip would be for us to pay attention to what the treasuries are doing, because that, if you kind of look at over time, this, 6, 12 and 24 month, you can really see that yield curve coming down. What's interesting is now CDs are kind of in line with what treasuries are paying. And so we're getting a lot of demand for CDs, which is kind of interesting. It's it's funny how I always kind of thought that was a passe product in the
Yeah.
banking industry, but it's kind of the hot new thing
It's coming
these
back in
days.
vogue.
So yeah.
It's funny you mentioned CDs. All right, so I think the last time that I had one was I cashed it in for my undergrad. So it was
last year.
quite some time. Yeah, thanks. Quite some time ago. And even when I was in banking before I got into public accounting, I was a new account rep among other things.
Yeah.
And even in the late 90s, like we still opened up CDs or had, let's call them legacy clients who really felt that it was a good place for investing.
Yeah.
And you're right. You hit a point earlier too. We, for better or worse, we'd enjoyed a stable prime rate for the better part of a decade.
Yeah, no question.
And so you do kind of get lulled into that sense of the returns are what they are, and I'm not going to put my money in a money market account. It's not paying the prime.
Yeah,
because prime itself is so low.
That's right. That's
so,
right.
Well, I'm sure you said again, 175 banks just locally.
Right.
So that has to put a strain on the labor market. And I imagine you guys, like us, and probably every other industry, are facing some labor challenges. So what do you see in the banking industry related to labor?
From the bank, I'll take the bank's perspective, and then maybe you can speak to the client's perspective. From the bank's perspective, as we talked about, a significant number of banks in this market. There's, we talk about from a banker's perspective, there are more banker seats that need to be filled because of the number of banks than there are super talented bankers to fill those seats. And so that has made the labor market much tighter.
You can find salespeople to put in those seats.
No question. That's a really good distinction. That's a really good distinction. And because when we talk about banker, we're talking about a more corporate finance minded value add partner that can help those business owners talk through whatever specific challenges they may be dealing with. But without a doubt, it's becoming a tighter labor market. We're building a business ourselves. I think that's one of the reasons our story resonates with many of our clients who are manufacturers and distributions and service type companies. They've got their business. Well, so do we. We're running our own business. It just happens to be a bank. But oftentimes, like those clients, our most valuable asset is people. I mean, our most valuable asset walks out of the door every night, and we hope walks back in the next morning. We're no more than just the overall consolidation of all of our folks. So it's what drives our business. It's what drives the value of our business. We're competing with a lot of other banks for those talented bankers out there to be able to serve the clients that Darren described that we serve. I think you're seeing, Darren, you can weigh in over the course of the last decade or so, some of those bankers moving more down market into smaller banks, maybe coming out of the big money center national banks, and into the regional, super regional, or even kind of large community bank segment, which is helpful from our perspective. Darren, what would you say you're seeing, I guess, from a client perspective? They're dealing with the same challenges we are labor-wise.
We hear it a lot. There's been a number of challenges, whether it be the labor market or, supply chain is another thing that we hear a lot about from our clients. And we're hearing that from our clients as far as just the challenges to attract and retain talent. Because there's a lot of options for folks, and as we have competition moving in the market, so our clients and different things. And so, finding new ways. I hear a lot about just creative ideas of how to do that, how to retain and attract key talent and that kind of stuff. I would say we are blessed to be in this market, in the DFW market. There's a lot of people moving into the market. So it's got to be better here than it is in other areas. But we do hear that. We do hear that a lot from our clients. And I would say that the thing is the way that's impacted some of our clients that I've seen is it just may cost more. So it may impact some margins, or there may be your expenses, whether it be, having to pay up for talent or labor, or paying, supply chain, or, stockpiling, So what ends up happening is the metrics of how the businesses run over time have changed too, which could impact cash flow. It could impact the balance sheet. It could have different impacts. And what I would say is, in the most part, we're staying close to our clients and hearing from them on a regular basis. We hear about these challenges, and we're kicking around ideas about it or getting ahead of those things. One thing that, if I was going to give any business owner a piece of advice for their bank is, we have this rule: no surprises. We bankers hate surprises, and so
Accountants.
Yeah.
Right.
That's never good.
No.
So how that plays out is we've seen, if there's a company that has like a field services business that's having to employ a bunch of people out in the field, and their vehicle fleet is expenses are increasing, chips and cars, and all the shortage there, and then trying to go and get talent to fill those roles. What ends up happening is the smart business owners and the smart operators will be way ahead of that and talking to their bank and really looking at their cash flow projection and their expenses, and really getting ahead of kind of what that might do to them. In as if they have to get a new contract and go staff up, like what's that going to look like? And so being ahead of those conversations with your banker and letting your banker kind of be part of that planning in that also gives your banker a lot of comfort when maybe it comes time to maybe deploy some, a loan vehicle to help support that piece of it, or kind of come in, and if there's a dip or something like that. It's just always good to be very connected and know, but that is something we're hearing a lot about among other kind of challenges in the market. But again, just really blessed to be here in DFW. I think we've got a great economy here that helps a little bit, but it is a topic that it absolutely is a top of mind of a lot of folks.
So for the bank itself, without giving away any top secret information, do you have a trick for sourcing the right types of folks? Is it a referral network, or do you have an internal program where you maybe identify some of the folks that have a propensity for sales that can also understand the bigger picture long term, maybe an internal training program, something like that?
You're talking about for us,
for the bank
specifically?
I think a lot of it, what we found is it's a pretty close knit group. This is my opinion, but I was in banking before the downturn. I started my career in the late 90s, and so sort of watched. But after the downturn in 2008, prior to that, a lot of banks had programs, credit training programs, where they would bring you, and I was in one of those, where they rotate through all the aspects of the banking, really get it in that you were trained to be a banker.
Maybe they send you off somewhere, New York or San Antonio or wherever.
That's right. And there are very few banks in town, around that still do that. It's starting to kind of come back. And so, after 2008, for the next, 5 to 8 years, banks really didn't hire anybody. And so there's a big gap in the talent pool for us. And so most of the folks that were kind of bankers before the downturn, I think we all know each other. And we're all over the place, and we talk.
We've been friends with each other. We've competed against one another on various pieces of business. We've worked with one another at various prior lives. So it's a well-known group.
And then, for those that are kind of up and coming and, and that sort of thing, a lot of times we'll get an introduction to somebody, or we'll run into somebody, or I'll hear, it's as simple as if I've got a prospect or somebody I've been talking to for a while and I just can't seem to smoke them out of their bank. Who's your banker? And then I'm going to go vet that person. I'm going to ask some of these people I just mentioned, hey, do you know so-and-so? Particularly for us is like we kind of talked about earlier, a lot of banks, as the bigger they've gotten, there's been everybody has a different play on what they want to do, whether that be investing in technology and AI and all that kind of stuff, or
building branches,
or building a branch network, or that kind of thing. Everybody's kind of got a different approach to it. But in general, as the banks get bigger, the idea feels like efficiency. So pushing kind of the lower middle market client down to like the retail channel, or that kind of thing, where you're going to get good bankers, but they may just be more kind of that order taker, salesperson looking to push a product or something like that. But the real good bankers out there that know how to dig in, understand the business, build trust, and then be responsive and be able to bring that expertise and that kind of stuff. They're hard to find. We don't particularly have a program. We're fortunate enough to have just a very senior team, especially in the commercial side, of bankers that, gosh, I 15 years probably minimum.
The least experienced banker probably on your team is 15, 18 years of experience.
And those folks are they're all pros. And so if somebody I knew was complaining to me over drinks about the bank they're working at, which is exactly how I got here, we're always looking for good talent. But we really don't have a program right now to kind of build up from scratch. Now there are times and instances where you may come across somebody that you see the potential as a leader or manager, and take a chance on that person and build them up and help them achieve what they want to achieve in a career. But so far, I mean, we kind of had and just to brag a little bit, our reputation in the market's so good. We have a lot of interest, and so we can kind of have run of the pick as far as the talent we want and need, and it's got to be the right fit, and it's got to be the right person. But we're always looking for talent to add to the team, because we continue to grow. I mean,
No question.
We've grown 25 to 30% every year since we started, and
yeah.
So as we continue to grow, there'll be opportunities for us specifically. But we a lot of what we have is just I have the opportunity to really invest in these people one-on-one, day to day, and help develop them and help them get where they need to go. And so it's more of a kind of a one-on-one type development program, I would say, rather than kind of a program.
It's a boutique white glove approach to that also, just like we have with our clients. Yeah,
exactly.
No question.
I'm listening though, and literally point by point by point, you could be describing the accounting industry.
Yeah,
exactly. It's the same way.
Yeah.
We all run in the same circles.
Yep.
Especially if you've got a little bit of gray hair and been around a while. And accounting firms merge.
Yeah.
But everyone's looking for the unicorn.
Yeah.
You're literally
a lot of similarities.
Yes.
Yeah.
Absolutely. So I want to reach back though. I want to pick up on a thread that you mentioned early on, and that was the use of technology.
Yeah.
What kind of technology or innovation do you see coming down the pike related to banking? What innovations do you see on the horizon?
Good question, Darren. You're more down in the weeds on the technology, and you're our technological expert. Relatively speaking.
Can I get that on the door?
Yeah. Put it on the business card.
Yes, that's right. It's interesting. For the last 40 years, banking has pretty much been unchanged as far as how money moves through the system.
Yeah.
We call it rails. So you have basically three rails that money moves, and that's checks, wires, and ACH.
Yeah.
And so you're starting to see things coming on like your Venmos, your Zelles, and that kind of stuff. Those ride on the ACH rail.
Those are all applications of ACH.
Yeah, they're just
right. Some people say, well, what about the rail of Venmo? Well, no, Venmo is an application under the ACH rail.
So it uses that. It uses that functionality to transfer money.
You got it.
Right.
Okay.
And they're in the there's obviously some challenges with the checks and the exposure to potential fraud and things like that. And wires are great because it's good funds sent, but you're really constrained between when the Fed is open to clear those wires through. And
it's
costly.
Yeah.
And ACH has a little bit of a lead time to clear through all that kind of stuff. So the new thing coming in the banking industry, which is kind of interesting, which a group of banks got together and just kind of said, hey, there's got to be a better way, right? It's called real-time payments. And that's kind of the new next wave of banking. And so we talked about technology, and it's kind of sort of what in our DNA, as Jason mentioned, we invest in our people and technology rather than branches and things like that. But we've got this platform that we're very focused on the technology. So I know about it because the real-time payments platform that's coming will allow folks to move money kind of in real time with funds as good as a wire. And so let's say you're a airplane charter business, and you've got a client that wants to fly somewhere, and it's a $40,000 trip, and it's Saturday afternoon, and you can take a credit card, maybe some exposure, but I'd rather get a wire for that to make sure that I can pay my pilots and fuel and all that stuff. But a real-time payments platform would allow you to send that money, Saturday night at 11:30 at night, and it's good funds and it's ready to go immediately.
Yeah.
And so as you look kind of, it's one application of it. There's so many different things you can dream up about how it goes, and in the future of it, it's pretty early. But as far as if you have to send money like that, I mean, what if the title business were to ever get into real-time payments? The fees, the cost would just be a fraction of what it would be to send good funds. Now that's a long way to go, but in general right now, most big banks, most regional banks are what we call real-time payments receiving banks. Like they can receive it. I think currently there's only 30 in the US that are sending banks that actually can initiate a real-time payment. Dallas Capital Bank happen to be one of the 30 in the US that's doing that. So we're currently right now piloting this with some of our clients. In those applications I mentioned, on how to and sending funds. Now, there's a lot that goes into that, and a lot of controls you got to consider, because you are sending good funds and it's gone.
Yeah.
You can't call that back like an ACH. You can't, that kind of stuff. So, we're starting to kind of pilot that. But for me, that's really exciting, because it's the first time in 40 years. I was, when I first started learning about it, I thought, oh, like you, like Venmo. Because if we split a pizza, I can just Venmo you the money, PayPal or whatever. But that really doesn't. That is just an application somebody's built to ride on that ACH rail.
Right.
What we're talking about takes banking almost more direct to bank.
Yeah.
There's still clearinghouse involved in that sort of thing, but it's not having to go through the Fed, who's only open on non-federal holidays and certain times, weekdays. So
right.
But it's interesting, because it's something that's going to, I think, really change the landscape of banking, is how money moves. You think about it, it's about time. I mean, information moves so fast. Your money should move just as fast. So
there's not been a new rail in 40 years.
Yeah.
Wire, checks, ACH are all that old. And so this will be the first new way for money to really move in many decades. Yeah.
My mother is never going to surrender her checkbook.
No,
she's
not going to be an early adopter of real-time
no,
payments.
She is not. She's still the one at Kroger writing the checks. But I get that, and I think it's interesting. I find it fascinating, honestly, because you take the concept of what most people envision as peer-to-peer, like a Venmo, but remove all the underlying machinery that kind of bogs that down a little bit. And I think that's very interesting, in that we haven't seen an innovation like this in quite some time.
Yeah, no doubt.
So
no doubt. I guess the only other thing I would add in addition to that, as it relates to business owners thinking about technology with regard to their bank, is just making sure you're with a bank, maybe as we touched on earlier, that's got a really good, user-friendly, advanced platform for their online banking, right? That allows good customization of dual approvals for wires, or allows you to set up your dashboard in whatever customized way you want to. I mean, if you're owner managed business, doing revenues of 20 million, 50 million, 80 million, you've got a CFO and a controller and an accounting staff. Having that level of technology with your bank is absolutely crucial. And it's one of the things that would differentiate us from some of the smaller community banks that do give really great client service, but in not all cases have been able to invest on the technology piece. And what we've tried to do here is both invest heavily in the technology piece, but then I'd say more importantly, overlay it with the service component, right? So you've got the same technology you should expect at one of the big money center banks, but you get the service component on top of it at a bank like this that you don't get at the big giant national banks.
And it allows us to outpunch our weight class quite a bit. And it's really important too, as Jason mentioned, is leveraging that technology too, because as we're starting to see out there's a lot of bad actors, and fraud is just on the rise, whether it be email, taking over an account or watching an email and asking for different things. But if you're running a business and you've grown and you've been using kind of a canned online program, and you've got somebody in the accounting that you just gave them your login, you're opening yourself up to potential issues. You may trust that person, but you never know who might have hacked that person's, because they've clicked on something or whatever. But as companies grow, as a business owner and as an operator with your banking partner, you've got to be having regular, at least annual sit down. Let's go through my setup. Here's what we're doing. Here's my staff. What do you think? And that's where that advice piece comes in, where we're going to sit down and look and say, hey, you're opening yourself up to exposure here. Let's set you up to where you've got the controls and layers in place to reduce exposure to the bad actors and fraud and that kind of stuff. And then fraud, fraud controls and things like that always change. And you need to be ahead of that as a business owner, and just anticipate that you're going to have check fraud at some point in time, because it's just so prevalent. You've got to have, kind of this awareness with your email and things like that on, people coming in and saying, oh, hey, I'm your vendor and we change banks. I need you to change my account number. Having policies and procedures in place to really make sure that stuff gets handled right, to minimize your exposure, and then have the right things set up on your account to catch those potential, fraud events. Whether it be ACH filters or positive pay or whatever it is. That's something as a business owner that I would say is really important to make sure you're sitting down annually, if not more, to just review what you've got set up, make sure you're not missing anything, make sure that there's not something new that we've seen that we can put in place to help protect you. But that's a really big deal.
Yeah, good.
Part of that though is having proactive conversations.
Yeah.
It's too late to shut the barn door after you've already had check fraud.
That's right.
So having those types of conversations early on, whether it's focused around fraud or potential opportunities for bad actors to take advantage of a situation, or even we talked a little bit about lending facilities and having proactive conversations about as businesses change and looking at what are the covenants on my loan and getting ahead of those types of conversations. I think about that particularly because there's a new accounting standard that is going to affect financial statements pretty dramatically, and we've been encouraging our clients to get in front of their bankers quickly to have those conversations about covenants and whether or not the metrics are going to line up the way they want them to.
You're speaking about bringing leases on balance sheet, which increases debt and is going to impact, you're right, all of your balance sheet covenants potentially. Yeah.
And I didn't want to open that can of worms necessarily, but that it reminds me again about having those proactive conversations is important.
No question.
You're absolutely right. And it goes back to the no surprises thing. We don't want a client to send us a financial statement and us go, oh, hey, what's this? Oh yeah, I remember. It's more of, you've got to think of your bank as on the same level as your CPA, as your attorney, as whoever is on your staff. And you got to be in front of it and having regular conversations, and even including as if I was going to come to you and ask for, okay, I'm about to buy this business, or I need some, what do I need to look for? What do I need to do? Do I need to set up another entity? Or somebody's going to come to you guys and talk about strategies around how to minimize tax exposure, or how to even just to put it together, or whatever it may be. We would just wish, and our PSA announcement would be, every client out there, please come to us and ask us for our advice, and we can get ahead of it. It's much easier to get ahead of it and to plan and figure out what's going to happen, rather than, oh, my line matures next week and I need to get it back in place, and oh, by the way, I had to do all this. That puts us in a tough position,
right?
Generally work through most of those things if we have good relationships, but if you're going to say, I want a relationship, and that relationship has a specific amount of value to you as a business owner. And so that's really where the rubber meets the road for us, as far as how our client, that's what I would wish.
My general rule of thumb is, if it is the situation where you feel that you would call your attorney, your accountant, and your banker.
That's right.
And I love my attorney friends, but just because there's a legal way to do something does not mean it's the most advantageous, either from an accounting or a banking point of view.
Totally.
So make sure that you're covering your bases as a business owner. Have those conversations.
Spot on.
Okay. All right. So I would be remiss if I did not bring up everyone's favorite R word. You hear whispers, depending on what periodicals and what your news source is. You can hear that maybe people are making some plans about a potential recession. I need you to gaze into your crystal ball and tell me what your thoughts are on that.
Well, we're 100% sure that there's going to be. Do we want to save this for the next podcast or the next webinar? No. Who knows, right? It shouldn't be left out that the slowing of the economy is what the Fed is intentionally trying to do by the raising of rates to combat inflation. So this is not necessarily a surprise. This is what they're trying to do. Now they're trying to get us to a soft landing, so to speak, and we'll see if we can accomplish that together. Yet to be seen. But without a doubt, the up 5% on interest rates in this short amount of time is fairly unprecedented. A potential recession is without a doubt a possibility. Darren, I think we're hearing from a lot of our clients the term kind of contingency plans. Some of our business owners, some of our best business owners, are starting to think through what are there going to be in advance, proactively thinking about, okay, if I start to see revenues down 10%, what's my kind of a contingency plan? If I see it go down another 10%, what's the next level of contingency plan in terms of staffing, cost cuts, margin adjustments, pricing adjustments on their own product or service, in terms of making sure they've got sufficient liquidity, from the bank side, cash on balance sheet and or borrowing capacity under a revolving line of credit. We are bankers, so always when we talk about revolving lines of credit, I feel like I have to say revolving lines of credit are not, the purpose of those is not to fund losses necessarily, right? No bank intends to fund the losses of a business under a revolving line of credit.
Yeah.
That's equity risk, right?
Yeah.
Revolvers are typically for true working capital needs, but without a doubt, there's a lot of seasonality in that, and a slight pullback. Yes, you need to consider your revolving line of availability in conjunction with your cash on balance sheet, and make sure you've got enough dry powder to get you through some reasonable pullback. I don't know, Darren.
I think anybody that's concerned about it is taking steps to plan for it as best you can. Now, we all hope that this thing, soft landing, is sort of like a butterfly with sore feet, maybe. That would be great. But
it's a great analogy.
That's a good one.
I like that.
But usually I describe my golf shot onto the green like that.
Okay.
Just kidding. But, again, it goes back to, I do think there's something to being in this particular economy. This is just such a great, we're very, very blessed.
No
I think we will see less of the impact of a possible recession here, but I think it's something that everyone is concerned about and planning for.
Yeah.
And it's really important. And it may just be, timing of decisions you're making, maybe put off some big key capex or whatever it is. Just trying to make sure
defer some things.
Defer some things, but like you say, who knows? So, but so far we're hearing it's things have been favorable up to this point still. So we don't, I feel like supply chain and all that kind of stuff that we just went through was kind of almost more difficult to navigate for some of our clients than what they're worried about in the future. They kind of feel like if we got through that, we can get through this, but it's going to be interesting to see. But
one of the benefits of our business is we see all of our commercial clients, and they typically have financial reporting on an ongoing basis, and so we've got hundreds and hundreds of clients, businesses. That's right. Hopefully, that's if they've got a good accountant, and if they don't, they should talk to you.
Thank you very much. I appreciate the plug.
But it does give us visibility across the board. Again, we've got companies doing 10 million of revenue to 200 million of revenue.
Industry
agnostic, all type of manufacturing, distribution, service type companies, all traditionally good cash flowing, profitable companies.
Right.
We always have an eye towards collateral, but we really look to cash flow to repay debt. But when we get those monthly or quarterly financial statements, it gives us pretty good visibility into what's going on in real time. We've got one of our best clients will call me up kind of once a quarter and just say, hey, I'm down in the weeds running my widget manufacturing shop all day, every day. I know you're seeing hundreds of other businesses out there. Let me take a little pause and give me some intel on what you're seeing just amongst all your other clients. So just trying to gain some additional intel where you can. And we've seen some of our other great clients kind of approach it from that perspective. So if you don't have a banker that you feel like you can do that with, you need one.
Yes. Yeah. So I'm reminded though, we keep hammering in on the idea of being proactive, and I don't think you can overstate that concept enough. But the axiom that I've always heard is the best time to get money is when you don't need it.
Yeah.
So if you do have concerns about a recession, don't wait to get your ducks in a row. Be proactive about having those conversations. And if you need maybe a larger revolving facility, or if you're trying to establish one for the first time, which can be a very detailed process. Don't wait until you're at a point where you're like, oh, I got to fund payroll. Like
without what's the saying you always have about the guy who's out of breath by the time he gets to you asking for a loan?
You never want to lend money to somebody that comes to you out of breath.
That's exactly
out
right.
of breath. I'm not lending you money.
That's exactly right. Yeah, once you've already had that decline, once you've already gone through layoffs, workforce reductions, round 1 and 2,
right?
That's getting late in the game to try to come to a senior debt provider who, again, we don't have an equity stake in these businesses' clients, right? So we don't get the upside that they get, nor should we. We just have the senior debt risk return. Right. So from that perspective, you're exactly right. The earlier, the better on all that sort of thing.
Even if and most lines don't cost you anything unless you have a balance on it where you have interest. Generally, there's not a maintenance fee for it.
That's right.
So it doesn't hurt you to have it.
Generally doesn't.
And just have it in your hip pocket just for, or an unusual or an opportunity with a CapEx purchase or some sort of some opportunity that's come down the pike that you didn't necessarily foresee, but now you've got the liquidity available to you to capitalize on that.
Yeah, that's right. Yeah, that's good.
All right. Well, we have just a few more minutes left. I want to touch on one other topic, which has been lately in the press, and that is the importance of monitoring your FDIC insurance. So What are some of the
heard that?
Have you been online? But no, truly, there are a lot of ways to structure your coverage through FDIC.
Yeah.
Having a banker that understands what those opportunities are and being able to capitalize on some of those things, of course, is going to be very important. Any quick or final thoughts on making sure your coverage is adequate?
Well, get with a bank that has a banker that can work through that with you.
Yeah.
I mean, we've got, I'm thinking of one individual one banker on our team out of our private banking group. We call him the deposit Jedi because he is so great at just maximizing FDIC insurance coverage by the different ways you can structure.
Yes.
Most people think of it's generally $250,000 per account owner kind of / per account. And there are some different things you can do to get a little bit more. You should have an eye on that. There's a lot of talk in the media, articles, and so forth about potentially the FDIC exploring the idea of raising the limit to something above 250. 250 for a business, for an operating checking account for a $50 million revenue business.
Yeah.
You're not, that you're not gonna have 250 in there. You're gonna have $4 million in there. Yeah. And so it just doesn't make sense today. I think I saw an article that said when the FDIC insurance was originally done back coming out of, I believe, the Great Depression, it was like $100,000 originally, and it's only increased to 250, in 80 years. Yeah. And 100,000 then would be like 3 or 4 million today. Yeah. And so maybe using that as a benchmark, one thing that the FDIC did back in the 07, 8, 9 financial crisis is they actually, some people know it and some people don't, for non-interest bearing accounts, they took off the 250 cap, unlimited FDIC insurance on non-interest bearing operating accounts for 5 years.
Wow.
Then that got everybody comfortable with that piece of it. And then that eventually sunset in 12 or 13 or 14, whatever, 5 years later, kind of without fanfare, and nobody ever thought about it again. So there's talk of maybe doing something like that. But you should have an eye towards it. I will say, even with some of the recent bank failures, whether you're talking about Silicon Valley Bank or Signature or First Republic, in all of those scenarios, even with all the consternation and worry about FDIC coverage, in all three of those instances, depositors were made completely whole. Oh. Equity holders got completely wiped out, and that was tens of billions of dollars of equity loss from the shareholder perspective. But from a deposit perspective, every single one of those was either backed by the FDIC or the FDIC and the Fed helped broker a sale of that bank to JP Morgan Chase and First Republic's.
Who, quite frankly, wants those deposits.
That's right. And now all those depositors are clients of JP Morgan Chase. Yes. And so they're backed by the good standing of JP Morgan Chase. And even if you would go back and look over the kind of 80-year history back of the FDIC insurance, typically that's the way those deals get handled by the FDIC. It's a very rare occasion that a depositor has taken a dollar loss over the last 80 years, no matter how much they had in deposit in a certain account. So anyway, you're right. It is top of mind, big topic these days.
Yeah, and I think that's, if you're running a $50 million business, there's no way you can spread that out. It would make your life miserable. And so,
you would need all 175 banks
you would.
in the Dallas-Fort area.
Yeah, 250 apiece.
Being conversations with your banker about that. Yeah. Just ask the questions. How's the bank doing? Do I need to be worried about this? When it comes to interest-bearing deposits, there are products out there where banks can, it's a company called IntraFi, which is kind of an insured cash sweep. But basically, if you had $1 million in the bank in a money market account and you were concerned about that, then we could put that product in there, and it would basically spread that exposure out over peer banks,
multiple banks, so that you would technically have that 250 coverage at 4 different banks. We would just be the sole bank. It's a really interesting product called IntraFi, and they do it on the money market side. They do it on the CD side. They also can do it on the non-interest bearing side. But it's a way for a client not to have to walk all around town opening up individual 250. It can be done on an aggregated basis. With us and with a lot of other banks that do it as well. It's pretty interesting.
I would say that FDIC insurance is a topic that obviously everybody's talking about. But as far as I kind of survey the conversations we've had since March, it's probably 1 in 8 of conversations. The rest of it is more focused on how to make more yield on their deposits.
Yeah, they want to earn a higher rate of interest on their deposits.
We've seen more concern about making yield than we have about safety and soundness. And I think that's there's so much in the media and that
Yeah.
sort of stuff, but really, that's one thing that we talk about.
Yeah.
And we talk about with my team, my bankers, is be a student of that, study it.
Yeah.
There's plenty of resources out there
Yeah.
where you can go study and kind of see what the articles you're talking about and that kind of thing, where you can go back and really look and see, is this really a big deal?
Yeah.
It's something to be aware of and something to talk to your banker about. But yeah.
Well, obviously, if it's not coming up in conversation very frequently, the other conversations really give you an idea of where business owners are in terms of headspace and what they're looking at in the future.
That's right.
And if again, awareness, but not necessarily like, let's not be a house of fire about it.
Yeah, no panic.
No.
Yeah, without a doubt. So hopefully that's helpful.
Yes, absolutely. Well, guys, we are pretty close to out of time.
Okay.
I believe we've got some good questions in the Q&A. So again, we will be following up with those on an individual basis. I can't tell you how much I appreciate you guys giving your time this afternoon. This has been really informative. I think we've got some great topics. You've certainly brought a lot of insight to us. So thank you very much for taking out your time this afternoon to be with us. And all of you online, we sure appreciate you joining us. Again, the housekeeping stuff, the email will come out with the certificates and the survey in the next 2 days. We'll also post the video online on our YouTube channel. And of course, if there's anything we can do for you, reach out to us, ask us at lgt-cpa.com. Thanks a bunch. Catch you next time.